All right, welcome to Chicago Title proudly presents Taxes and Your Transaction. Just a quick commercial. We want to remind everybody that we have a Start in Here mobile deposit program that will save your clients a trip into our office with their earnest money deposit. This allows both your clients or you, if you happen to get that EMD check, to deposit the check just the same way you may be doing it with your bank by taking a couple pictures and submitting it. So if you have any questions about how that works, don't hesitate to reach out to us. We also are offering a program for our realtors called In Here that allows you to track your transactions as well as get pertinent details of the transaction even after closing. And we're going to be coming out with more information on that program in the coming months, but it is up and running. And with that, I'm going to turn it over to Anna Getman to talk about our agenda today and what we're going to cover.
Good morning, everybody. Thank you so much for logging on this Friday, wonderful Friday morning. We are going to cover today taxes in your transaction. As we all know, there's various types of transactions that have life in a transaction, whether they could be property taxes, unsecured taxes, and transfer tax. And if you find yourself not in an unfortunate situation, but just a maybe bit of a challenging situation on a transaction, you can be dealing with franchise tax board taxes and or federal taxes, IRS, our best friend. So basically, we will cover understanding the property tax calendar, which is a big one. If you leave today with anything, I want you to leave almost being an expert of understanding the property tax calendar. We're going to also cover how we prorate those taxes and including unpaid taxes, whether they're supplemental or regular annual taxes. We're going to cover impounds in the mortgage accounts and how that relates to the property taxes and what time of year that you really need to pay attention to, especially if you're representing buyers, because that could be a little bit of a sticker shock for your buyer. I mentioned before supplemental taxes, when they come into play, how long it will be until you see them come into play, if at all, and what you need to know about supplemental taxes. We will cover the federal and state, the 1099, the 593 reporting and withholding. We do not deal with any kind of capital gains type situation, but we do issue 1099s and we deal with this California State Franchise Tax Board within our transaction in each and every transaction. We will go over FIRPTA, what that means to you, what that means to us, and how we are involved with that. And then we'll also go over special tax assessments, Mello, Roos, PACE, HERO, all that good stuff, the stuff that makes us giddy. Transfer tax, how that's calculated, we'll go over, and typically who pays that. And if you find yourself in a transaction outside of our county, that may differ, but we can go over that as well. And then how ChicagoAgent can take some of the guesswork out of your taxes. Now, I love our ChicagoAgent because if I don't have an active order that I can plug in numbers and look at my preliminary title report to see what the property taxes are, our ChicagoAgent is, that's how I do all my net sheets for transactions that do not, that are not quite open yet, because that app, that program, desktop program, does figure those out for you as long as you put the address in there. And then we'll go over any questions or any questions that you have that I may be able to answer at the end of the presentation. So understanding tax prorations. So the purpose of a tax proration in a sale escrow is to fairly divide the taxes between seller and buyer, so that each party is paying only for those days which they actually own the property. Who wants to pay taxes that they actually don't owe? So this is the reason why we prorate taxes because you close an escrow within a tax period, an installment period, whether it may be the first or second. And so those dates do come into play. So the tax year runs from July 1 of any year to July 1st of the following year. So you have one complete 12 months. Now, that's a little confusing because we go, we have a calendar year from January to December. So it's like, why doesn't the tax office just make it, make those taxes live from January to December? That's the one answer I don't have for you today. So it does not follow the, like I said, the standard calendar. We are currently, this is a little bit of older slide, but right now we are currently in the second installment of the 22-23 tax year. Okay, because the second installment started January 1 and ends June 30th. The first installment started July 1 of 2022 and ended December 31st, 2022. So and we do have great handouts. So if you leave today and feel like it's still confusing, or I just don't understand it, or it's just a good cheat sheet to have when you're talking to your clients about taxes, we're happy to provide that to you. But yes, we are definitely in the second installment of 2022-2023, and come July 1st of this year, 2023, we will be starting the first installment of the 23-24 tax year. Okay, so in regards to that, and this may be a slide coming up, but people have a misconception as to when the taxes are due. So you have a first installment that begins July 1st, and then you have a second installment that begins January 1. And so people think that their due date for those taxes for the first installment is actually December 10th. And for the second installment, they think it's actually April 10th. And that's a myth. Those are the dates that you have to pay them. So come December 11th, come April 11th, your taxes are now delinquent. So truly, for the first installment, your taxes are due November 1st. And for the second installment, your taxes are due February 1st. Now, this gets a little sticky and a bit difficult and a bit costly in the fall, because those installments are due so close together. And when you are handling a transaction that is being financed, these lenders have certain criteria to make sure that taxes are paid, number one, on time accordingly. And if they are impounding, like I said, we're going to go over a little bit more about that they're collecting enough. So if you are handling a transaction in the fall with the buyer that's having their purchase financed, it's very important that you pay attention to how much the taxes are at the time, when your close of escrow date is, what your lender requirements are on, how many months are to be paid. So your buyer does not have sticker shock, not only for what they're paying in property taxes, because that does need to be disclosed to them, but what their impound account is going to look like, and how to front load, how much is going to need to front load that impound account. So again, taxes are due November 1st and February 1st. They are delinquent after December 10th and April 10th. So I hope I've cleared this myth of the due dates being the 10th of December and the 10th of April. So Jen, you can go to the next slide. Thank you. And so I want to be careful on this, as tax bills are mailed out in October. So larger counties find this a little bit difficult. I know it's kind of funny because it's like, okay, if my taxes are due November 1st, shouldn't I have my bill out well before that? Shouldn't I know what I'm paying come November 1st? That would be ideal. But larger counties like Fresno, you literally get that tax bill maybe a week before their due date, like in the latter part of October, but that tax bill will be for, of course, the first and second. So come the second installment, you're going to know what it is. So they do issue. Smaller counties like Madera, those tax bills can come out as early as September, but that date is still November 1st delinquent after December 10th. So if your buyer is a first-time home buyer and they have closed in the spring of that year, they may be looking for that tax bill during that summertime. Just know that they typically aren't going to get them until October sometime. Okay. Prorations at closing. So the way we prorate is we typically collect from the seller if the taxes are due. And we do that typically most of the year. If we close after July 1st and before that bill is issued in October, we prorate as if the buyer's actually eventually going to pay that bill when it comes out. So anytime from October to December 30th, we charge the seller for those taxes at closing, and we credit them for the time frame that they don't own the property. For example, if we close today, April 21st, and in ideal situation, the taxes already have been paid because they went delinquent April 11th, and the taxes have been paid. If we close today, I'm going to credit that seller from today to June 30th. So they will get, for example, if their taxes were $1,500 that they paid in, between February 1st and April 10th, I'm going to take that $1,500, figure out how many days there is from today to the 30th of June, and do the math from the $1,500. You divide that by 180 days and get your what they call like a per diem, and I'm going to multiply that how many days there's left to June 30th, and I'm going to give that calculation, that amount of credit, to the seller because they paid the property taxes in the installment that we are living in at the time of closing. So that is a seller situation for that proration time frame. Now, if we are to close July 31st of this year, and we're now into a new installment. Well, I don't have a tax bill to go off of because remember, they don't get issued until October, but we're closing July 31st. I prorate off of the last known issued tax bill. So remember that $1,500 that we talked about? So for the sake of showing this or giving this example, I'm going to use the same amount. Well, the last installment from the previous year is $1,500. We are closing July 1st. I'm going to use that $1,500 as the proration estimate for the buyer. And I'm going to put it on my statement that the buyer is going to pay that $1,500 come November. And I'm going to prorate because the buyer did not own the property from July 1 to July 31st. I'm going to give the buyer credit for those 30 days with that same calculation of the $1,500, because when they go pay the full installment of the $1,500, even though they didn't own the property the entire year, they get their credit up front before they even paid it. So it's going to show on your closing statement as a credit to the buyer for a future tax installment that they're eventually going to end up paying, and that is going to be for the entire installment. So I hope I didn't confuse anybody, but that is like the most easiest example that I can give you as far as proration goes. And of course, all of this changes depending on what year or what time of year you close. If you close in the fall, it gets a little because if you close in the fall and we're so close to a due date, so say we close in November of this year and those tax bills are out, then that debit credit proration kind of flips. I'm charging the seller now because I know the bill is, what the bill is, and the seller is not going to own the property from November, say we close November 5th, from November 5th to December 30th. So I'm going to give the seller a credit for that time frame. So that's how prorations work. I hope I didn't confuse anybody. It's a little sticky, but it's super important to understand, because your buyers and sellers are going to be either debited or credited a certain amount, and they need to understand why. So to take that burden off of you as an agent, we do go through those explanations with the buyers and sellers. But should they ask you that question, I'm hoping that you're prepared from my examples. Okay. What if taxes are in default? So come December 11th, come April 11th, those taxes now become defaulted and are delinquent. So what happens is the tax office charges 10% as a penalty. So if your installment is $1,500, they will charge a 10% penalty for the first installment. If the second installment is delinquent, they charge the same 10%, but they tack on an additional $10 for the delinquency of the second installment. And so if we are closing, we do pay those current, and we do pay the penalty. If we are closing after those dates and the taxes are delinquent, whether they're the first or second installment delinquent, or whether both of them are delinquent, we do pay those penalties and late fees in escrow. Okay. Properties can be sold at public auction after 5 years of delinquency. This is near and dear to my heart. The reason why is that is called a tax sale. If the property owner does not pay their property taxes for consecutive 5 years, the tax office does have the right to take the property for unpaid taxes, and they sell it at a tax auction, and that's called a tax sale. For the sake of not opening up a can of worms, but I feel like it's super important to mention this. If you get a listing and you find out that it was acquired through a tax sale, you're not dead in the water, but it's a little bit more of a process. Tax sales are very difficult. They're to be insured. The property is difficult to be insured, but it's not impossible. So just be careful. If you end up listing a property that has been acquired through a tax sale, those typically cannot be insured until after ownership has been held for 5 years by your seller, at least 5 years. And at that point, it's still a case-by-case basis. Underwriting has to approve it. Now, there is a caveat. There is a company that's called the Tax Title Service Certification Company. That was a tongue-tied company that issues tax certificates. They do all the research. They do everything that needs to be done that's necessary for a title company to insure the property. Unfortunately, there's very little title companies in the state of California that will do it. However, I work with that. But the only reason why, without going into the whole process, the only reason why it's important for you to understand this is because that process can take up to 60 days. And that is above and beyond your normal escrow process timeframe. So just know that if it's an additional 60 days, and it could be anywhere between $2,000 to $5,000 in additional fees, because of course this company does charge additional fees to get to the point to issue a certificate to insure that property. So if you find yourself in that situation, call me and I'll be able to give you all the information necessary. Here's our impound schedule. So remember I mentioned earlier about how in the fall, it kind of gets a little bit, it gets a little bit more costly for your buyer. And as you see, where the monthly payments, they see if your first monthly payment is either October or November, those are the most amount of months collected. We're looking at 8 to 9 months. The reason why is because those taxes are due so quickly come November 1 and February 1 for the second installment, the lender needs to know that they have enough funds in the impound account to pay out those taxes for your buyer. So this is a good thing to keep on top of your tax calendar, installment calendar, impound schedule. Ask this, request this from our sales execs and keep these with you because they're great cheat sheets and they're going to save you and they're going to make you look like a superstar because they're going to make you look like you have, not look, you're going to have all the great information. So ask for these things. But this is what I was talking about. And I'm glad that we have this up because it's a great visual because I keep saying that the fall kind of gets a little sticky and this shows you why. Okay. What are supplemental taxes? This is my favorite too. I have lots of favorites. I don't know why. I think this is why Jennifer had me teach this tax classes because I love taxes. Supplemental taxes between 3 weeks and 6 months after a property is purchased by a new buyer, the county assessor will appraise the property and give it a new valuation. Okay, the supplemental tax reflects the increase in value. You will be informed of this and have a window to apply for a homeowner's exemption and or file an assessment appeal if you feel that the value is inaccurate. Okay, a lot of this had happened when when values kind of declined a little bit, but the tax amounts were still based on the higher value. A lot of people were applying for exemptions and appeals, because the taxes were based on an inaccurate because of the values had gone down. So right now taxes are going up because the values are going up. And so at that point, they have to account for the gap. And that's where supplemental tax bills come into play. The county will then calculate the amount of the supplemental tax bill. The supplemental tax bill will identify the amount of the supplemental tax and the date on which taxes will become delinquent. I do want to shed some light a little bit on new construction. If the transaction is being financed, it typically isn't a huge issue because the lender will. And I'm sorry, I should say, if the transaction is being financed and there's an impound account being established, the lender typically will account for enough impounds, enough collection of taxes to cover any kind of supplemental tax bill. However, having said that, if that's not the case, you do need to educate the buyers that in new construction, they could get a very whopping, supplemental tax bill, 6 months after they close escrow. The only thing I can advise is that they contact their lender and they do have an impound account. There may be enough in that account to cover that supplemental tax bill. Now, if they don't have an impound account, they just need to be aware that that is going to happen because of new construction, because the last time that land was assessed, it was bare land and that tax bill was probably next to nothing. So just be aware, as like when I bought new construction, I received a $4,000 supplemental tax bill. So just be aware. It's kind of a good mental note to have. New construction, big supplemental tax bill. Okay. All supplemental taxes on the secured roll are due in 2 installments, like we said, first and second, and the supplemental tax bill will give you these dates. So those supplemental tax bills do get split up. So like that 4,000 that I got hit with, the tax assessor's office, tax collector's office allowed me to pay 2,000 and change, on a specific date. Those dates don't align. I'm getting feedback. Okay, those dates don't align with the normal tax dates, the November 1st and the February 1st. So just keep in mind that those supplemental tax bills will have specific dates. And then those are the dates that the tax collector's office chooses. Okay, it is a one-time tax. And the following year, your property tax bill will be raised to reflect the new value. So you do get that one-time tax, and then the tax office adjusts the following year. And so from there forward, you will have the same tax bill. Now, having said that, as things increase and inflation happens, the tax office does reassess properties from time to time without there having to be a transfer, and property taxes, it could go up, but you probably won't be issued a supplemental tax bill. Your normal tax bill will increase. Okay. Next, so we're closing the chapter of the book on property taxes and going into federal taxes. We issue 1099s, which is our federal form. It reports gross proceeds according to the sales price, and that's what we report. We do not collect any taxes that has to do with your federal income tax. The only federal taxes that we have anything to do with is if there's a federal tax lien against the buyer or seller and attached to the property. And then 1099 is mailed out February following the tax year. So we do mail out all 1099s the following year. However, in our closing package for the seller, we issue a substitute 1099 that they hold on to. So either or can work. Some, maybe depending on their tax bracket or their tax situation, sometimes maybe they, do quarterly, whatever the case may be. They will have at least a substitute 1099. They have one in there in their closing package if they qualify for us to report. We do have a form in our seller package. It's a questionnaire. Depending how they answer that questionnaire will determine whether we issue a 1099. So there could be transactions that we handle and close and a 1099 is not issued, but it's the way the seller answers true and false corrections that we have. Okay. Tax reporting requirements. This form is a snapshot example of our 593. This form is the California Franchise Tax Board form. This is not a Chicago title form. I stress that because we have a fiduciary duty to distribute this form on every single real estate transaction that we handle that's above 100,000. Okay. If your sales price is $99,999.99, we will not be issuing this form because there is a ceiling, or there is a threshold. Any sales that's 100,000 and above, it's our fiduciary duty to issue this to the seller, and they are required to fill it out accordingly and sign it. And we are required to send every single form that we close. We are required to send this form on every single transaction that we close on if the sales price is above $100,000 and above. I want to say that is a good idea at the beginning of the transaction. If you feel your seller needs some extra time, especially now, at the beginning of the year up until, April or so, because it's tax season. It's a good idea to maybe ask your escrow unit that you are involved with in the transaction to provide this form to your sellers ahead of time, because if they're not familiar how to fill out this form, or they are unsure how to fill out this form or answer these certain questions, they may need to reach out to the CPA. And if the CPA is pretty busy with tax season, it may become a problem. The reason why I say it's a good idea to hand this to them ahead of time, because I, as an escrow officer or any escrow unit, is unable to advise them on how to fill out the form. I cannot counsel them. I cannot advise them. And that goes for the same for you as an agent. You should not be advising them, because that could have some implications. So we are not CPAs. We're not tax professionals. Even though we are given this class, we are not these type of tax professionals that I'm speaking of. So this is the 593 form, and it's not a form and that's why I say it's not our form. It's the Franchise Tax Board. So it's not something that we have to sit and type. it's readily available the moment you have an escrow open, and it's super easy to request it from your escrow unit and have it emailed to your seller directly with you being CC'd, or if you want a copy of it, just request it. Okay. And this is page 2 and 3. As you can see, it's very cumbersome. And this is the reason why I stress that it's a good idea to provide this form ahead of time to your sellers. We typically don't do that just out of practice. It would need to be requested. And for the most part, this form is distributed to the sellers at least 2 weeks before closing. But if you're finding that your sellers seen this a couple of days right at closing, that's probably not a good practice, just because if they are unsure and they have lots of questions, that may potentially delay your closing, because this does have an effect on their proceeds, how they're dispersed, and who are they dispersed to. Okay. FIRPTA. Okay. FIRPTA is the abbreviation of the Foreign Investment in Real Property Tax Act. Okay. Buyer is the withholding agent. I know that sounds kind of funny. It's like, okay, it's a reporting system for the seller, but the buyer is responsible as a withholding agent. Well, as with anything, sometimes it doesn't make sense. It has anything to do with this kind of entity. Buyer is responsible to confirm if the transfer is a foreign person. If transfer is foreign and the withholding agent fails to withhold, withholding agent can be held liable for the tax. Now remember, who is the withholding agent? The buyer. The source that you can go on is the IRS, this website, and it talks a little bit more about why the buyer is the withholding agent, and so on and so forth. And so when it gets to this type of situation, you have to be careful on who has access to taxpayer ID, the seller's social security number, the seller's taxpayer ID. So you have to be careful who has, access to that, possession of it. So that is why we are a qualified substitute for the FIRPTA. So we have a form that the buyer signs that substitutes us to make sure these requirements are being met, because it's our fiduciary duty to deal with these entities. But we have, we're bonded, and we have all the things in place that to ensure the seller that their social security number, taxpayer ID is safe and secure with us. We don't sell information. We don't do any of that. So we substitute ourselves in as a withholding agent, but the buyer does sign a form with one of our forms stating so. Okay, so we confirm that the transfer is not a foreign person, and then we make sure whether there's a withholding or not. Well, we don't police those forms, how they're filled out, however they are filled out and returned to us. We just take information from how they're filled out and we act upon them, because we take instruction. Okay. Special assessments. Mello, Roos, and other special districts. If Mello, Roos exists, you will not only see it on our preliminary title report, you will see it reflected on your natural hazard disclosure. Not only will you see it on the preliminary title report and the natural hazard, if you go as far as requesting a tax roll, like a tax statement, it'll be a line item on the taxes. Okay, so these tax assessment districts are usually created by the developer to absorb costs for infrastructure improvements and ongoing costs. So you have 3 sources, 3 references on Mello, Roos. If they exist, they will reflect on all 3: the natural hazard disclosure report, the preliminary title report, and the tax statement. Okay. Pace and Hero. So this came about quite some time ago, years and years ago. It's little by little, not kind of rearing its little head in preliminary title reports, but there's still some out there. And it's basically a program that the county had implemented, put in place for improvements on single family residents, whether they were giving loans for new roof, AC, solar, additions to, the property, whatever the case may be, however it qualified. And for example, say if it was a new roof and it was $30,000, well, they were issuing these Hero Pace, for the lack of better words, loans, and then amortizing them and integrating them into the taxes and collecting the repayment through the tax installments. So what that meant for a homeowner, if their installment was normally, before a PACE Hero loan, was $1,500, and they participated in this kind of program, their tax installment could easily have been, as soon as the project was complete and everything was done and the taxes and the amount was added to the taxes, the way it worked, I think the cycle was like one tax installment, then you would see what your new taxes were, could very well go from $1,500 to $4,000, because this amount had to be collected some way, somehow, and the county implemented this program, and that's how they came up with about to collect on the amount that they had provided to the homeowner to make these improvements. So you will see these on a preliminary title report, but they will not be glaring. They will not pop out at you and say, I'm a lien. They're going to be right after the tax installment on the preliminary title report. And it's not going to say, I'm a lien. It's going to say an assessment for a contractual, whatever the case may be that they used the money for. It does not look like it. Unfortunately, we have policies and procedures that we have to report on our preliminary title report, how the document is recorded. So the document is recorded as an assessment of a contractual, so on and so forth. And that's how we have to reflect it on our preliminary report. However, if you are looking at our preliminary title report through our Live Look program, this will be a red item. So our Live Look does yellow, green, and red. This would be a red item. So that's our way of screaming at you, hey, real estate agent, hey, seller, hey, buyer, this is something that we need to deal with. This is something you need to pay attention to. So that is a good way to review a prelim, is through our Live Look prelims. And if you have questions, we can address that later. Transfer tax. Transfer tax in Fresno Madera County is assessed at $1.10 per thousand and is charged to the seller at the time of the transfer. Now, I mentioned earlier that depending on where your transaction is, it depends on who's going to pay for this. Well, in this area, Fresno Madera, this is typically paid by the seller. So if you want to give your seller an idea of what they're looking at for transfer tax, you can just take your potential listing price and do the multiplication, the math on it. It's $1.10 per thousand. That's a fee that goes directly to the county to transfer the property. It's not a title and an escrow fee. It's a county transfer fee. Okay. So the ChicagoAgent one, I mentioned earlier that I love this program because it does all the thinking for you. If you put the address in the ChicagoAgent, it's going to search for that property. It's going to search for the tax record on that property, and it's going to give you the amount that currently the property is being assessed at for that tax installment. So putting in the address and the close of escrow date allows the app to prorate your taxes for the buyer and seller. Withholding is also automatically calculated based on the sales price entered. So if you want to give your seller a, hey, heads up, if you don't qualify for the exemption from the withholding, this will allow you to give a more realistic bottom line to your seller, because it's going to calculate that 3.33% California Franchise Tax Board withholding off the sales price. And it's going to give you that collection amount that we have a fiduciary duty to collect and send to the Franchise Tax Board at closing. Okay. Oops. All right. If you I do want to say one thing on that franchise tax board withholding. If for whatever reason your seller just does not want to fill it out, sign it, again, we still have a fiduciary duty to send that to the tax office, and we have to write on the 593 that the seller refused to complete, and we have to automatically withhold. And then that's something that the seller has to work out between them and the franchise tax board after closing. With any kind of government entity, we do have, our hands are tied in certain instances, and that is one of them. If the form is completely filled out and we withhold, your seller will get a copy of the form of the check that we mail to the franchise tax board, and a copy of the 593 voucher payment, the payment voucher that we send. They will get that in their closing package. So when it's time to prepare taxes the following year, they have all the appropriate documentation to provide to the tax preparer. Okay. And that's it. I hope I shed some light on some of the mysteries about taxes. I did mention, oh, one more thing, I'm sorry. If you find yourself in a situation where there's federal tax liens and or state tax liens on a property or against your buyer or seller, those type of liens we will order, but please keep in mind, we can't just order straight out, right out the gate. Those government entities have certain forms that are required to be filled out and signed by the taxpayer, and will not respond to our request for payoff until those forms are submitted. So if we are in the situation of that, please encourage your buyer and or seller to complete those forms that we will provide them as soon as possible, because with anything of that matter, it could take up to 45 days, if not more, to get that office to turn around and give us a demand. So that's another thing. I just wanted to put that out there. Okay.
Thank you so much, Anna. So at this point, we are happy to open it up to any questions. If you've got a question for Anna about anything that was covered or a situation that you've encountered, don't hesitate to unmute and ask, and we'll give that just a couple minutes. I'm going to stop sharing so that everybody's faces can be on the program.
There is a question from Ana Rosa. It says, how do you anticipate any tax increases? Do you hold a cushion? If so, how much? We do not hold any cushions. Regarding any proration of taxes, we have to go off the last tax installment. Regarding lenders and establishing escrow accounts, they do have a small 2-month cushion on the calculation of the last issued tax bill. That is the only cushion. Now, having said that, your buyer could easily, after a couple of years, get a letter from their lender saying your monthly payment is increasing because we received your new tax bill and the property taxes did go up. So they will go, of course, adjust their monthly payment to, to cover that increase. But as far as escrow is concerned, we do not cushion anything. We do because there's no way for us to know if that property is going to be looked at by the assessor's office, if they're going to continue with the same installment as they did the previous year. It's just too difficult. So we do have to just go with what the last issue tax bill is. So I hope I answered that question.
Hi, Anna.
Hi.
Hi, my name's Gilbert. I was calling, looking at, just listening here. So if the property is in a trust, okay, property in a trust, okay, the grantor of the trust, right, of the heirs, there's like 4 siblings, okay. So she fills out a 593 form, correct? Right. The trust. Okay.
Yes.
Now, How about the heirs? The heirs, do they do anything like fill out a 1099 form? How are they taxed individually?
They would be taxed individually when they go sit with their tax preparer and report what they got as far as any kind of inheritance from the sale
Correct.
out of that
Correct.
trust. We
Correct.
do not deal with any beneficiaries within the trust and what they get paid out, because we actually do not pay them out. When we close escrow, we pay out the trust. So for example, Anna Getman, successor trustee of the Robin Albert Family Trust, that proceeds will read Anna Getman, successor trustee of the Robin Albert Trust. Now, say Linda Federico Johnson and Jennifer Shepherd are beneficiaries of that trust, and now that I close, I have to pay $50,000 to each of them from the proceeds that I received from that trust proceeds check.
Mhm.
Escrow has nothing to do with that, because that happens after the close of escrow, and it's, of course, it's their responsibility to report that inheritance disbursement to whoever's preparing their taxes. So no 1099 gets issued to any beneficiaries from a trust at closing. It only gets issued to the trust.
Okay. Thank you.
Okay.
Any other questions? All right.
Either I bored you guys or I'm really, really good. I'm giving you all the information.
We have
Either
another
way,
question
I'm
in
super
the
excited
chat.
that you showed up.
Okay, there's another question in the chat. Could you explain again what happens if the seller doesn't want to fill out the withholding tax form, and who is liable for those taxes after the property closes?
Okay, so because the California Franchise Tax Board places that responsibility on the escrow company, we have to, whether we have to provide one of two things. Like, there is no way around it unless the sale price is below 100,000. We either have to provide a fully filled out executed form to either explain that there is a withholding, or explain that the seller is exempt. If there's a withholding, we send the form plus the check. If there is an exemption, there's no check, obviously, and we have to send the form. Now, if the seller is unwilling to fill that form out, we still have to, because of the unknowing of whether they're exempt or not, we have to, and I don't like to use the word assume, because we work on instruction only. But remember, technically, the Franchise Tax Board is instructing us, so we're still working on the act of instruction. We have to write on the form that the seller was uncooperative or unwilling, or whatever the case may be, to complete and sign the form, and we are withholding the full 3 1/3% from the purchase price and sending that withholding to the tax office. And that seller is now responsible to deal with the California Franchise Tax Board to work out whether they were exempt or not, or that amount should not have been sent, or whatever the case may be, because this form does allow for the seller to do alternative withholdings to prove that they are exempt. So there is a lot of variations in the form, but if they're flat out just refusing, we have the higher up instruction, I guess, should I say, from the Franchise Tax Board takes precedence. And so that is what happens. And then ultimately the seller is responsible to figure out whether that amount was necessary, correct, or whatever the case may be. I've only had one seller refuse to fill out the form and sign it in the last, how many years I've been doing this, 25 years. And I sent the amount, 3 1/3 of the sales price, and the form, and it's up to them to figure that out after the fact.